Hey guys, it's Hakeem here, welcome back to the channel, and in today's video we're going to be looking into Corsair Gaming, considering the fact that they've just released their Q4 2021 results. And actually in the after hours the stock hasn't moved at all, which I was quite surprised about, because having gone through the earnings report and gone through the earnings call transcript, well, there's quite a few gems in there which actually signal some very positive moves for the business going forward. But despite that, the stock basically hasn't moved, it's down 2%, right? So we'll get into the earnings report, we'll look at the fundamentals of the business, then we'll also look at my updated valuation for the business to see whether this is a good opportunity to outperform the market in the long term. Now, it goes without saying that Corsair Gaming has been on a wild ride since coming to the markets in September 2020. The stock IPO'd at $17, it then ran up fairly quickly, right the way up to $45 by February 2021, and ever since then, inevitably, it has absolutely fallen off a cliff, right, and we're down around 55% from its all-time highs. So naturally, people are asking the question, does this present a buying opportunity? Are we now seeing good value for the stock, considering it's pretty much sitting at the same price it was back when it IPO'd in September 2020. But as I always say, just because a stock has fallen by 55%, it doesn't mean that it can't fall by another 55%. And as a result of that, we need to dig into the fundamentals to see what's going on with the business and whether this is a good opportunity for the long term. So without further ado, let's get into the video. Now, the first thing to mention here is that Corsair Gaming is a small cap company. It's valued at just $1.9 billion, which is interesting because when we flick to their full year results, we can see that they just recorded annual revenues of $1.9 billion. So it's currently trading at a price to sales ratio of just 1. And that plays a large part of the reason as to why so many people were excited about the stock back in February 2021, because as you can see here that for 2020 they reported revenue growth of 55%. So you can imagine a stock that's trading at a price to sales ratio of 1, but is growing at 55% year over year. Now that starts to get very exciting. However, inevitably that revenue growth fell off a cliff, and the reason for that is because effectively a lot of their revenue growth was pulled forward as a result of people staying at home and therefore upgrading their gaming systems. So we saw revenue growth of 55% in 2020, and that has fallen all the way down to 12% for 2021. And that's why a lot of people are now actually bearish on this company, because they think that there's not that much growth left in the business. Which, by the way, is a ridiculous assumption when you actually get into the details. This business is certainly not going to be growing at 55% year over year, pretty much ever, but we are going to see a sustained period of growth. Now, there is one important thing that I want to point out to you from this key highlights section, and that is that Gamer and Creative Peripheral segment net revenue was $647 million, which was an increase of 20% year over year. Now, considering that the overall revenue growth of the entire business was 12% year over year, well, then you can quickly work out that this segment is growing a lot faster than the rest of the business. Now, why is that important and why am I telling you that? Well, the reason for that is because the Gamer and Creative Peripherals has much higher gross margins than the rest of the business. So we can see here that Gamer and Creative Peripherals carries gross margins of 35% compared with just 23% for the rest of the business. So if this segment here is growing at a higher rate than the rest of the business, then what's that going to do? It's going to drive up the gross margins, the overall gross margins of the business as a result of that. And therefore the business becomes more profitable, and as a result you get more of that revenue flowing down to the bottom line. Now, with that being said, we can see that gross margins are on a major decline for this business. So we can see here that total gross margins for the full year were 27%. However, for the quarter just gone, we're sitting at just 24%. So clearly that's a concern. And the best way to dig into understanding what the reason for that is looking at the earnings call transcript. So whenever I want to find out any financial news, financial information, take any financial data, or look at earnings call transcripts, I go across to TIKR Terminal, and you can see here that they've got a section for transcripts, and you can see that the latest call transcript is right here. So it's really easy for me. Now, historically, gross margins for this business have actually been improving over time. And part of the reason for that is because they're seeing a high percentage of direct-to-consumer sales, which means they aren't having to pay a third party, such as Amazon, to sell on their websites. So that naturally drives up gross margins. So just a year ago, direct-to-consumer sales were sitting at 9%, and actually now we're up to around 11%, and management are expecting that to continue to increase. So that is going to help gross margins, but why have gross margins fallen so significantly? So the reason for the decline in gross margins is pretty much the same as what every business is experiencing that have to rely on a supply chain, and that is that shipping costs have increased exponentially. Now, we've all seen that freight and logistical costs have increased by as much as a factor of 10, so clearly for a business like Corsair, that's going to hurt them massively. And the reason for that is because they have to ship products into the business, and then they also have to ship products out of the business, so they sort of get hurt on both ends of the supply chain. However, we're expecting that over the long term, certainly 1 or 2 years from now, that will have eased, the supply chain will have eased, the pressure on the supply chain will have eased, and as a result of that, costs should then come down. So just to recap, those 3 variables that we're expecting to push gross margins higher for the business are the fact that they're seeing a higher mix of higher gross margin products. We're also seeing a shift to direct to consumer, and then on top of that, we're expecting logistical costs to actually come down over the long term, and as a result of that, for things to normalise in the business and therefore see higher gross margins over the long term. So out of that $1.9 billion in revenue that they generated, it actually cost them $1.4 billion, and that leaves them gross profit of $514 million. Their sales, general and administrative costs are $316 million, which in my opinion is very high. And actually I think that as the business gets larger and as they scale, that cost as a percentage of revenue will actually decline as well. And then we see product development, which is effectively research and development, right? Trying to come up with new products, of $60 million. That leaves us with operating income of $138 million. They incurred interest expenses of $17.5 million, which is actually half what it was in the year prior, so that's very good to see. And the reason for that is because they're making a massive effort to pay down their debt. And then they've also got some other expenses of $5.5 million. So that brings us to income before taxes of $115 million. Subtract some taxes of around $14 million and we get around $101 million net income for the business over the trailing 12 months. Now, considering the fact that the business is valued at $1.9 billion, that gives it a PE ratio at the moment of around 19. So it's not exactly an expensive business. With that being said though, that net income figure is actually $3 million less than it was for the prior year, despite generating an additional $200 million in revenue. So that gives you an idea of the scale of how much their costs have increased over the last year or so. And then we come down to the balance sheet, and it's not bad, right? But it's not that good either, to be honest, right? So we've got here cash and restricted cash of $65 million, and that was actually $133 million the year earlier. So we're going to get into the reason for that fall in cash. However, whenever you see restricted cash, you want to pay attention to that because effectively it's not really their cash, right? That means that there's some terms and conditions that are on that cash or restrictions on that cash, which means they can't actually spend it freely. And ultimately, they're actually going to just have to give that cash to somebody else. Effectively, they're just holding the cash for somebody else. So what we can do is we can flick across to the earnings transcript to try and see whether management have mentioned specifically how much of this cash is actually theirs. So we can see here that management said we ended the year with $248 million in debt at face value and $62.4 million of unrestricted cash. So out of that $65 million that we're seeing here, $3 million of that is restricted. So clearly that's not an issue, but you should always make sure to pay attention to restricted cash just in case that figure was much higher. So then we come down to the cash flow statement. So we can see here net income of $101 million that we saw in the income statement. They then make some adjustments for non-cash expenses. So we've got here stock-based compensation, depreciation, amortization, and so on. We get down to cash provided by operating activities of around $20 million. They then subtract some purchases of property, plant and equipment of around $11 million. So look, we're looking at a sort of free cash flow for the business of around $9 million for the year. So despite the fact that they're generating $101 million in net income, why is their free cash flow only sitting at $9 million? And the reason for that is effectively because they've been stockpiling, so they've been pumping a lot of money into buying inventory to try and ensure that they aren't impacted as much by the supply chain issues. And we can see that in the inventory balance here, and they also mentioned this on the earnings call. So we can see here that inventories have gone from $226 million up to almost $300 million. So that's effectively $75 million of additional inventory that they're holding this year compared with last year, despite the fact that revenues have only actually increased by around 10%. And these are the kind of things that you want to be paying attention to when you are analysing the financial reports of a business, because they help to paint a picture of what the business is doing, what the management is doing to try and alleviate any issues that they're facing. So yes, whilst free cash flow this year is significantly lower than what we were expecting, actually over the long term, we're not expecting the business to continue to try and stockpile, right? They're not always going to increase their inventory because we're not always expecting to be living in a world where we have supply chain issues. Now, I don't want to dig too far into the details of the business because effectively I've already done a video on it and I don't want to be repeating myself, and I'm sure you guys don't want me to be repeating myself either. So I'll link in the description the link to that video. So then that brings me on to my valuation model for the business, which consists of a discounted cash flow and earnings multiple model approach combined as one, and then I also have a 2026 price target based on a multiple of EBITDA. We've got a current enterprise value for this business of $2.1 billion, and that's taking into consideration $62 million in cash and then also $248 million in debt. I've incorporated into the model my estimate for either share buybacks or share dilutions. Now, it's a little bit more difficult for Corsair Gaming, and the reason for that is because they only became public in September 2020. With that being said, I'm saying that effectively over the next 5 to 10 years, I'm not expecting them to issue any shares, and I'm also not expecting them to buy back any shares. I'm just expecting for that to remain flat. And the reason for those assumptions is because the company is cash flow generating and also the financial health of the business is pretty fine. And as a result of that, I don't see any immediate need for them to be issuing shares to raise cash. And if they do, then it's probably for an acquisition, which will increase the growth of the business, which I haven't incorporated into my model. So I think that that's probably fair to leave shares outstanding as flat over the course of the period. Now for 1 to 5 year revenue growth, I've gone with 10%. Now management have come out and said for the full year 2022, they expect net revenue to be in the range of $1.9 billion or 0% growth and $2.1 billion, which is 10% growth. So I've gone for the upper end, and the reason for that is this. Management have said that they're expecting revenues to be at $3.5 billion by 2026. Effectively what they're saying is that they're expecting relatively low growth in 2022, and then 2023 onwards they're looking at somewhere in the region of around 15% per year. In my model, I'm just going for a flat 10%, and actually my model suggests that they won't hit $3.5 billion in revenue until 2028. So clearly my model is more conservative than what management are expecting. Where in 2026, I'm expecting just under $3.1 billion in revenue, but I think that that's probably a fair estimate. I'm then expecting revenue growth to slow down to 7% year over year, whereby in 2031, we hit revenues of around $4.3 billion. So clearly, I don't think that this is going to be a fast growing business, and that's okay so long as you pay a fair price for the business. Now we can see that for the last 2 years, they've managed to achieve gross margins of 27%. With that being said, we just saw in Q4 2021, their gross margins fell down to 24%. I'm actually expecting gross margins to be 27% for effectively the first few years before increasing to 28% and then 29%. And the reason for that is the variables that I mentioned earlier on, which is a higher mix of high gross margin products, as well as a shift to direct-to-consumer sales, and not only that, the easing of the logistical issues that we are currently facing. Now, in terms of operating expenses as a percentage of revenue, I'm expecting that to go effectively from 20%, which is what it was in the last year, and for that to fall down to 18%, which is actually the historical averages for this business. After taking into consideration taxes and interest expenses and so on, we're looking at a net profit margin to start at 5% in 2022, which is pretty much in line with what they achieved for 2021, and that is to increase slowly up to 8% by 2026. So clearly an increase in net profit margins from 5% to 8% is good, but I don't think it's out of their reach considering that they're actually selling more higher gross margin products, as well as that we're expecting just general operating costs to decrease over time, not only because of logistical issues that they're having, but also as they continue to scale. I'm expecting those sales, general and admin costs to actually eventually decline slightly. As a percentage of revenue, that is, not overall for the business. Then we come on to my discounted cash flow, and we can see here that we've got a weighted average cost of capital of 9.9%, and that's driven by this calculation here. I'm expecting EBITDA margins to remain at 10% for the next couple of years before slowly ticking up to 12% as those margins continue to increase. Now for unlevered free cash flow as a percentage of EBITDA, well, this has been very choppy, right? It's been as high as 111%, 96%. It's been as low as negative 38%. So clearly this is quite difficult to forecast. However, having gone into it, I'm expecting 30% for 2022, 50% for 2023, and you can see effectively that slowly increases up to 70%, where I think then it should stabilize for this business. So then that brings us on to the fair value for the business, and according to the discounted cash flow, we're looking at around $31 per share in terms of the multiple of earnings, which I've used a PE ratio in 10 years time of 14, which is probably about right? It's not a high margin business. We're looking at net profit margins by that point of around 8%. We're expecting growth to be around 7%. It's not massively growing, so I think 14 is probably fair. Looking at an intrinsic value of just $21 a share. Take the average of the two, we're looking at somewhere in the region of $26, or a margin of safety of around 30%, which, considering how conservative I think I've been in my assumptions, with exception probably of the margin expansion that we're seeing, I think margin of safety of 30% is actually pretty good. And then moving on to my 2026 price target for the business, well, we're expecting EBITDA in 5 years' time of $368 million. I've applied an enterprise value to EBITDA multiple to that of 11. Now, in terms of the rationale for that, well, it's a little bit more difficult for this business because it hasn't been public for very long. Therefore, you can't really get much of an idea of what people are willing to pay for the business. With that being said, you can look at the fundamentals of the business and then consider what you think a multiple should be to that business. So we're looking at a business that's got net profit margins of around 8%, EBITDA margins of around 11%, and it's not all that fast growing. So I think a multiple of 11 is probably fair. And then just to corroborate some of those assumptions, we've got here a chart using TIKR Terminal of the last 12 months enterprise value to EBITDA multiples that investors have effectively been willing to pay. We're looking at an average of around 15. Now the problem with that is the fact that it includes when people were willing to pay a 30x multiple, which doesn't really reflect the fundamentals of the business. As a result of that, if we take that away, we're looking at an average of somewhere between 11 and 12. And I think that that's probably reasonable for this business, and I expect that to continue into the future as well. So I've gone with 11, slightly on the more conservative side, because I like to be conservative in my assumptions. As a result of that, we're looking at a price target in 2026, if we assume that shares outstanding remain the same, of around 41, which would imply a compounded annual growth rate over the next 5 years of around 15%, which isn't bad, I think, considering the fact that I've been more conservative in my assumptions than what management are actually expecting. And not only that, I've used some relatively low multiples as well. Anyway, guys, I hope you've enjoyed the video, and until next time, thank you.